Yeah. A very good afternoon to everyone. I am CA Saket Manish Mehta, Vice Chairperson of Amravati Branch, the moderator of this webinar. So we are delighted to welcome you all in this webinar, which is being organized by ICI CP Committee, that is Continuing Professional Education Committee of ICI. It's my pleasure to be a moderator for this webinar on corporate restructuring and the future of auditing, digital assets, and AI-driven assurance. In a short while, we will start this webinar. First, I would like to appraise you about CP Committee. The profession of chartered accountancy is growing leaps and bounds, and its phenomenal growth has brought the profession at the forefront. Today, our profession has acquired an indispensable position in the business and economy. ICA continuously aims at developing knowledge age so that the members stand out to the expectations of the society. To achieve this objective, the CP Committee of ICA has been continuously striving for perfection, integrity, and knowledge, which makes the word chartered accountant synonyms with excellence in service. In this direction, CP Committee has always been proactive to the emerging needs of its members, enabling them to acquire a contemporary knowledge and skills to face the challenges effectively by organizing CP programs and providing an adequate opportunities. So the program for this evening is as follows. We have two sessions of 1 hour each, and the topic for today's session are as follows. First session will be on corporate restructuring, that is changing dynamics, which will be taken by CA Nehal Shetzer from Ahmedabad. And the second topic will be on the future of auditing, digital assets, and AI-driven assurance, which will be taken by CA Archana Dudeja Madam from Faridabad. And I would say that our today's eminent speaker will talk about these two mentioned emerging areas of professional interest. So before giving charge to our first session speaker, I would like to give the brief introduction about CA Nehal Sheth sir. Sir is a co-founder and partner of boutique consulting firm of more than 45 CAs with domain expertise in tax and regulatory matters. He has over 20 years of experience in advising on taxation, exchange control, and regulatory issues. He has advised clients in the areas such as structuring of mergers and acquisition, private equity, group restructurings, fund advisory, succession planning, estate planning, tax litigation, and compliances, etc. So, with this brief introduction, I would like to welcome our today's first webinar session speaker, CN Nehal Seth sir. And I also feel proud to inform you all that more than 425 participants have already joined for this webinar. And one important announcement, I would like to inform all our participants that there will be no webinar on the upcoming 25th of December 2024 on the occasion of Christmas and it being a public holiday. So now I would request our first session speaker, CA Nehal Sheth sir, to please take the charge over this session. Now over to CA Nehal Sheth sir.
Thanks a lot, Saket ji.
My pleasure, sir.
Thank you for the kind words and the introduction. And again, my special thanks to the CP Committee of ICI for inviting me to share some of my thoughts on one of the subjects which is very dear to me and some which I have been practicing since almost more than a decade now, which is corporate restructuring. I'll just share my presentation, just one sec. It's visible?
Yes, sir, it is visible. You may please proceed.
Oh, thanks. Friends, I think the topic is, of course, corporate restructuring, and I don't think 1 hour is really a time in which you can justify this particular area, because there have been lots of complexities and a lot of emerging issues which we encounter on a very, very regular basis. Uh, if I were to give a presentation probably 2 months down the line, I can assure you 25% of the presentation would have still changed. Nonetheless, I think I will try, and what I'll do is I've divided my sort of presentation into two parts. One is, of course, uh, I have tried to, given the short time, I will focus on some of the emerging issues and the recent developments which are shaping the corporate M&A today. And then, time to the extent of time permitting, I will also go to the fundamentals and the basics of most of the restructuring areas and the options. Okay, so that's how I'm going to structure the presentation. Um, it's a very different world we are living in terms of the IPOs and the unicorns and crazy valuations, cryptocurrencies, SPACs, I think proxy advisors. So what essentially happens is that the regulations somewhere start playing catch up to the requiremements which are happening in the business world. Uh, what happens is that what we see is that a lot of the areas where there are the business is changing at a rapid pace, but the regulations and the regulatory framework may not be really relevant or may not be equipped to deal with it, and therefore there's always a catch up which is required there. Uh, the different or the interesting thing about M&A and why it's very dear to me is that it requires a very, very holistic understanding of all the areas impacting the corporate M&A. So it's not just about income tax or Companies Act, but whenever we look at any corporate restructuring, we need to look at income tax, GST, stamp duty, FEMA, SEBI regulations, Ind AS, accounting, Competition Act, and then there could be some industry-specific laws, valuation requirements, right? So the complexity is really incredible, and that is what makes it very, very very interesting. Uh, for example, let's take a simple case of a valuation. All right. You may be required to do a valuation in a particular manner under and from a particular agency under FEMA. You may have a different method and a different agency under income tax. Right. Companies Act will have another agency requirement. Accounting standards will require you to do valuation in a different manner. So what essentially is a simple valuation exercise can probably lead you to multiple agencies, multiple valuations, multiple methods, and multiple reports. And that's what, and somewhere you need to ensure there's parity among all of them. That's what makes the M&A world very, very interesting. Uh, Again, the laws are always framed for exceptions. The objective is that to for the problems which are created by few, you sometimes end up punishing many, because of few outliers or few areas which have been misused in the past. Certain laws are created, and when these laws are created, they somewhere end up impacting everyone who are not even intended to be impacted. And again, that creates a bit of complexity in the overall M&A world. Uh, I think what I have been emphasizing mostly is that, unlike most areas of tax, where we see that the tax advisors or the tax consultants come at a much later stage in the with the client on the table to discuss a particular issue. M&A is one area where the chartered accountants has to be involved from day zero, right? The entire structuring of a particular transaction, considering the various laws and considering the valuation implications, that needs to be thought through and implemented upfront. It is not just enough to look at the commercial aspects, but how you will interwove the commercial aspects with the tax and the regulatory reality is what is really the need of the hour. Again, most important thing which I have seen, and somewhere I feel that no M&A is complete without, is the knowledge of accounting standards. And this cannot be emphasized more, especially with the introduction of Ind AS. I think if you do not have the in-depth knowledge of the Ind AS or the accounting standards which are applicable in a particular transaction, it's really, you will feel very incomplete, and your ability to advise the client will definitely be limited. So I think this is what makes M&As extremely interesting. It's the regulatory maze and the interplay of various laws. And also there could be various industry specific laws, uh, in the, let's say, retail sector, or it could be in the context of power sector. And again, knowledge of those becomes critical when you are doing M&A for those particular sectors. So what could be the various drivers why a person or a company is going to go for structuring, right? So one, of course, it could be that value unlocking. Sometimes conglomerates are uh, having multiple businesses, and therefore the intention of a structuring is to unlock the value of a particular business, right? Which is somewhere, because it is lying in the middle of a mix of various businesses, the value potential is not recognized by the markets. So a structuring is undertaken to unlock that value. It could be for a simplification of group structure and transparency. There sometimes the promoters over time have created a web of companies, and then at some stage you reach where you now want to clean up the structure, have a simplified structure, adhere to corporate governance norms, and create transparency, which is which ultimately leads to more lesser compliance costs. Uh, so that could be one reason, simplification. There could be M&A structuring for, let's say, some eliminating a competition. It could be for entering new markets, or it could even be for uh, something as important as succession planning. That also drives a lot of M&As. So these are various structuring drivers, and which have been sort of, in my experience, uh, have been the focus areas whenever we have been discussing the potential options with the client. And it's extremely important to understand the perspective of the client, and the what is really driving his entire M&A exercise before really deep diving into the tax and the regulatory maze. So what I'll do is that, considering this is just a 1 hour presentation, okay, I thought that probably let's first start with something which I've already done in the end, which is the new developments. So I'll first take all of you through some of the very recent developments. Of course, it's not an exhaustive list, but definitely something which is very important for all of us to know. And then we will then go to the fundamentals and the basics, and that we can of course cover till the time we have time, till the time is there. Because when we start with the fundamentals, we can even spend a day discussing it. So that's the reason I thought, let me take the reverse course for the particular presentation. So let's take the first box. I'm sure you can see the slide, and therefore let's see the first box, which is the dematerialization of shares. Now, the MCA has mandated that all private companies have to, except small companies, as on March 31, 2023, have to issue securities only in demat form. Uh, I think this definitely is something which is going to be a consideration in all M&As going forward, as it essentially enhances the business efficiency, creates more transparency in share transfers. It could reduce legal aspects, legal disputes relating to share titles. So some of these issues which we have seen when the foreign partners are investing in India, and they have these concerns in terms of the physical share certificates, and how that can have challenges in terms of legal title disputes, etc. But having a demat definitely sort of cleans up most of these issues. At the same time, demat means that any buyer or a seller will, and let's say is a foreign buyer or a seller, then he will need to, or let's say is a buyer and he needs to invest in an Indian company. Now, because of the demat, he will need to open his own demat account in India, right? So therefore, there's an added bit of a process and a procedure which will be required in an M&As. So again, this is a while it is a welcome step, but it does lead to some bit of process and compliance procedures for the foreign buyers. Uh, the another is the, of course, the fast track mergers. So again, uh, inbound mergers have been now permitted under the fast track route, and I have a separate slide on this. So of course, I'll discuss it when we go to that slide. Share swap Again, FDI, ODI swap is now permitted. Again, I have a separate slide on this. So we'll sort of discuss this when we go there. Uh, the next, I think, is on the capital reduction versus buyback. So essentially, capital reduction is governed by Section 66 of the Companies Act, and buyback is governed by Section 68 of the Companies Act. Now, whenever we have seen that many times companies, for let's say minority squeeze out, in the sense that let's say a company was earlier a public company and then listed company and then it became unlisted. So at the stage of unlisting, it delisted its shares, but let's say there were few minority shareholders which remained in the company. So the company would now like to, give a fair value or fair exit to these minority shareholders on a compulsory basis by reducing their capital, right? So there can be various reasons why a company can sort of cancel their shares and extinguish the shares and pay certain money to the shareholders, either to some of them or to all of them. Now the question is that is this similar to a buyback, or can it be done through a scheme of capital reduction? The reason is that buyback has certain limitations in terms of the how much you can buy back, and pro rata requirement to buy back all shareholders. Capital reduction, because it's done through a scheme of arrangement under section 66 of the Companies Act and is approved by the NCLT. The flexibility is there to achieve many more objectives than you would have ordinarily achieved through a buyback. So historically, shares have been bought back through the scheme of capital reduction. Uh, what happened was that in a certain NCLT ruling, especially of Kolkata Tribunal, the tribunal held that the cancellation of shares under a scheme of capital reduction is nothing but a buyback. And they went to the definition of capital reduction and said that under the definition of capital reduction, what is not permissible is cancellation of shares and paying the money. It can only be done in certain circumstances, and those are not specified in the which is specified in Section 66. And what is being achieved is nothing but a buyback of shares, and therefore that cannot be done under Section 66, but has to be done under Section 68 of the Companies Act. So this, and again, recently we have had a favorable ruling of another tribunal. So essentially, what we are saying is this is a debate whether capital reduction is possible by way of cancelling shares and paying money to the shareholders, or it has to be done through a scheme of buyback only. With due respect, I can say that probably the view of the legal fraternity, or the view which we have been normally taken is that the definition of capital reduction in terms of what can be achieved is a very exhaustive definition. It essentially means that you can achieve capital reduction in the language used in any manner whatsoever, and more particularly. So what is being written there in terms of what can be done as a capital reduction are only illustrations. And therefore, what is not written there is also permissible to be done, because it's done in any manner whatsoever. And because of this particular language, the general belief is that even a buyback of shares is possible through the scheme of capital reduction. However, we have seen different tribunals in the country taking divergent views, and therefore, this is sort of a saga as of now, which continues. Uh, the next point is, of course, the press note 3. Uh, Again, this is something which was introduced a few years back, and it essentially means that any investment which is coming into India under the FDI rule, which is Schedule 1, uh, from a country which has sharing a land border with India. So essentially, the target was China, but the language uses countries sharing land border with India. Then that requires the prior government approval. So again, this is a very important, development. It's not a recent development, but there are certain recent nuances which have come up in this. The original intention of this is that this covers all investments from countries sharing land border with India, whether directly or indirectly, and therefore, in all our situations, or with our most of our M&A discussions, we always end up discussing issues like, what do you mean by indirectly? Let's say you have a company which is based out of USA, but that company has a 15% shareholder, which is Chinese. Okay, and this US company is investing into India. Is Pepino 3 applicable, right? What is the threshold? So there are of course limits, and there are of course certain stand which have been taken in the fraternity. There are essentially two stands which we have seen. Most banks are taking a 10% beneficial interest. Some banks are taking a 25% beneficial interest, and these are in line with the thresholds of beneficial interest which are given under the PMLA law. So most banks are saying that as long as the thresholds are the thresholds of investment or this indirect investment is below this number, then you need not really go for the government approval. But again, this creates a bit of uncertainty. Questions like whether Hong Kong is China, or whether Taiwan is China. So those questions are other nuances which we need to keep in mind. But what's been an important update here is that recently the government has been a bit proactive and has recently cleared many proposals uh, from the landlocked countries, especially China. So I think somewhere the maybe the mood and the intention in the government is that there is a need for FDI, and as long as there are various clearances available, including the security clearances, then they would probably approve the those transactions. So that really is therefore something which can lead to more M&As from these landlocked countries. But nonetheless, they still remain under the government route. So there's no change in that particular stance. Uh, the next stance is, of course, the abolition of the angel tax. And trust me, this is probably one of the most draconian laws or the sections which I had seen in recent times. Not only was it very difficult when we had negotiations and discussions with non-resident investors, that really, what is the law? How can share premium be taxed when you're already complying with RBI and FEMA, right? How can government tax your share issuances? So I think there was a bit of definitely lot of you can say that discomfort in the international investing fraternity, that how can such a law be there, and it's really draconian. It essentially means, and I mean, let me take a step back. Essentially means that when any company issues shares to the shareholders, either resident or domestic, or non-resident, at a share premium, and if the share premium is excessive, based on a valuation of the company, right, then the excessive share premium can be taxed in the hands of the company. So this angel tax was something which we had seen routinely being disputed by the tax revenue authorities, and the notices were sent. The companies were asked to justify the valuations. And not only was the law draconian, but it was even extended to non-residents some time back. And that again created a big hue and cry. But the government has very prudently, listened to the all the representation which have gone to them, and they have abolished the tax. So no tweaking here, no changes, no amendments in rules or section, but complete abolition of angel tax, and that too from April 1, 2024. So with retrospective from the beginning of this financial year. And that really is a great boon as far as the for FDI or the foreign investments in India is concerned. Uh, the next point is of course GAR, and when GAR was introduced, we had a lot of sort of academic debates. When can GAR be invoked? What circumstances? What could be defenses? But trust me, friends, in recent times, GAR has now become a reality. We have seen more and more cases of GAR being there. Okay, most of them have been favorable, but many of them have been favorable on procedural reasons, right? But at the same time, there have been cases where now GAR has been sort of invoked, and has been really upheld. So the very important is the recent case of bonus stripping, which was there. If I recall that, it was in the case of Telangana High Court, and the case was that the because the bonus stripping is covered by 94(8), and that specifically covers certain circumstances of bonus stripping, which is dividend stripping. Therefore, it is a SAR, which is a special anti-avoidance rule. And when there is a SAR, the general anti-avoidance rule cannot be applicable. In this particular ruling, the the courts have ultimately held against the SSE. While this is a petition, so it's a dismissed, and therefore it's not discussion on merits per se. But it has held that SAR can override GAR, or sorry, GAR can override SAR in the circumstances and facts of the case. It has held that in that particular case, the assessee himself said that bonus stripping is not covered by 94, and therefore there's no question of being SAR. And when there's no SAR, there's no question of having a discussion whether GAR overruled SAR or not. So I think there were a number of areas where the assessee argued, but ultimately it was held that because as a general anti-avoidance rule that can be evoked because it is notwithstanding any of the provisions of the act, and that also includes these special anti-avoidance rules. With again with due respect, sometimes bad facts can create a bad law. This particular case is not a very simplistic case of bonus stripping, but actually, in this case, there was a complex web of transactions which preceded the entire bonus stripping structuring, right? And therefore, it is in light of those backgrounds and that facts that the court ultimately held that the invocation of GAR is appropriate, and therefore the writ petition was dismissed. Right? Uh, with I had was reading a blog by Mr. Pramod Kumar, and I think he somewhere said that this ruling per se should not be a base for any future discussions on whether SAR, whether GAR overruled SAR or not, because this particular case had a very unique set of facts, and the law has to be read in the context of those facts. So again, the controversy is there, but the short point is that every structuring which we do will need to be tested from the lens of GAR, right? And of course, where GAR is not applicable, where SAR is not applicable, we always have JAR, which is the judicial anti-audit rules, which is essentially the laws created under various judicial precedents, where the any tax avoidance can be struck down if the purpose of any structuring is that. So again, very interesting times because it's not going to be very easy going forward. And with the taxman now having a new tool in his hands, definitely everything will have to be sort of seen from that perspective. So now coming to the share swap, and I think that's one of the important developments which I had sort of mentioned in the beginning. So what happened was that in August 16, 2024, the government came up with a notification where they amended the non-debt instrument or the NDI rules under FEMA. Now the reason now with this amendment, they have liberalized the entire share swap regime. So very simply, let's look at what was the share swap regime before the amendment and what is it after the amendment. Before the amendment, when the what was permitted was that in case an Indian company acquired the shares of another Indian company, okay, the acquiring Indian company could issue shares to the foreign acquirer, right? The foreign seller. The reason was that the particular provisions as it held before the amendment did not permit issuance of shares by the Indian company against acquisition of a foreign company. The rule said that only when an Indian company acquires another Indian company, right, then only in those circumstances you can issue shares to the foreign company. Now, what happens because of this? Because of this, essentially what happens is that if the structuring involves an ODI leg along with the FDI leg. So when an Indian company issues shares to the foreign company, that's the FDI leg. But then if along with this FDI leg, there's an ODI leg, which is that the Indian company acquires shares of another foreign company, and against that acquisition of another foreign company, it issues shares to the foreign company. So the FDI, ODI, if the structure had both these legs, then that was not permitted under prior to the amendment. Now, what is being permissible is the popularly as we call it the FDI ODI leg. It means that if the ICO is buying shares of FCO2 in this example on the right hand side from FCO1, and as a consideration for that is issue shares to FCO1. So the acquisition by ICO of FCO2 is an ODI, and the issuance of share by ICO to FCO 1 for as a consideration for this ODI is called FDI. So this particular now ruling now permits the both FDI and the ODI leg under a share swap, and therefore to that extent this is a very welcome liberalization. Very interestingly, the ODI rules as they stood earlier did permit the ODI rules as they stood earlier did permit the swap from ODI to ODI. So which is essentially that when you sell one ODI company and against that you issue shares to another ODI. So the two ODI legs were permitted, but again bankers had a different view there. I think with this amendment, a lot of these things have been clarified, and now where there is an FDI leg, where there is an FDI ODI leg, where there is an ODI ODI leg, the last one is still subject to certain comfort from the bankers. But by and large, all these three legs are now permitted because by virtue of this share swap amendment. Uh, I think the next point is that if we can look at the various modes of restructuring, right? So essentially, and I'm sure all of you are aware that restructuring can be done by way of merger, demerger, acquisitions, capital reorganizations, and conversions. And acquisitions include asset purchase and share purchase. And asset purchase again could be by way of slump sale or itemized sale. Capital reorganizations can be by way of buyback, splits, and consolidation or capital reduction. And then we have conversions of conversion into company, conversion to LLP. It could be an LLP into company, reverse. So a lot of these things are there. So this is the overall gamut of restructuring which we see in any corporate restructuring exercise. So let's take a very simple issue with us. Business transfer versus share transfer. If there's a seller and if there's a buyer, and both of them agree to sell a particular business or a company to the other person, right? What's the best way to achieve it? Now, many times as an advisor or as a counterparty to a transaction, our view changes depending upon which side we are, because there are certain advantages in certain routes which are beneficial for a business transfer, and some routes are beneficial for a share transfer. Uh, More so, and when I say business transfer, it could be slump sale or itemized sale. And when I say share transfer, of course, share of the company, entire share of the company. So let's look at all the parameters and let's understand which is favorable to whom in which circumstances. So the first parameter is succession or historical risk. So if the seller is selling a business to the buyer, but not the shares of a company, but his company is selling the business under a slump sale or an itemized sale to the acquirer entity, right? So from the perspective of the buyer, the legal entity is not being acquired, but only the business is being acquired, and therefore the historical risk or the success is much lower in this case. Yes, there could be some succession related issues, but by and large, since he's leaving the legal entity behind, but only acquiring the business, his ability to ring fence the liabilities and to acquire a business in a more insulated and in a ring fenced manner is much higher. So that's why in this particular case, the the mode of the mode of advantages would be business transfer, and it will be advantages for the buyer. Leverage buyout, I think I'm just having a case study, so probably we'll discuss that at that stage. Tax losses. Again, tax losses are at an entity level, and so if you buy the entity, then you may be able to claim the tax losses. But if you were to buy a business, then the tax losses remain with the seller. So from the perspective of the buyer, a share transfer is a more efficient manner if there are tax losses. Cost step up. Again, you might be paying a business which has a book value or a tax net worth of, let's say, 100, but you are paying 500 for it. Okay, if you just do a simple share purchase, then the entire 500 rupees of share purchase remains as an investment in your books. Right. And the entity is able to therefore not take a cost step up on that additional 400 rupees which it has paid. But if you were to do a business purchase, then you maybe have an ability to buy the entire business worth 100 for 500 rupees. And once you buy for 500 rupees, you can allocate that price to various assets, tangible, intangible, etc., and claim depreciation on these assets. So your ability to get a cost step up is higher if it is a business transfer, and this therefore benefits the buyer. Seller tax cost. So, if the seller is selling the business from a company, then what happens is that he receives the funds in the company, and then he has another cost to upstream the funds by way of dividend or capital reduction or buyback or whatever means we choose from the company to the shareholder. So there is a two level of taxation which can happen. Alternatively, the other way to do it is that if the seller were to sell the shares, then in that case, he directly receives the funds in his own hands. And therefore, for him, it's a much more easier way to repatriate and upstream the money in his own hands. Again, if you see the contracting objectives, uh, business transfer, buyer gets a cost step up, he's advantageous, but share transfer, seller gets a tax advantages by earning the consideration in his hands and therefore advantages to him. So essentially, in either case, it all depends upon the requirement, the commercial objectives, has a more bargaining power in a very, very fact specific given case. As advisors, of course, our view could very different. I mean, our advice could be different to a buyer as well as to a seller, depending upon whom we are advising. Continuity of the business, naturally, when you buy the shares, the business continue as it is, and therefore your ability to get the transfer of registrations, licenses, employees, approvals, etc., is much more easier in a share transfer. But if you were to do a business transfer, then the legal entity of the business changes from A limited to B limited, and therefore there has to be a physical process done to transfer each and every approval, license, registrations, employees, contracts, liabilities, assets, everything has to be transferred from A limited to B limited, and therefore it might disrupt the continuity of the business. So from that perspective, definitely from buyer's perspective, if he's looking at continuity, then share transfer makes sense. So again, like I said, what are you looking at, and whether you're a buyer or seller? What parameters are more important for you? Is continuity more important? Is cost step up more important? Are you more wanting to mitigate? You're buying a 50-year-old business and there are a lot of litigations and huge amount of contingent liabilities, but you love the business, you want to buy it as a buyer, but you are not comfortable. Your diligence, in when you do the diligence, you find that there are a lot of liabilities which could potentially be risky for you to buy as a buyer. Then you may still want to do a business transfer, though there can be some tax losses which you may be willing to forego. But you believe that for you, the parameter which is more important is a historical risk, right? So it again depends upon who you are and what parameters are important. That all depends, and that will ultimately decide whether you want to go for a business transfer or a share transfer. Uh, I think we discussed on the leveraged acquisition structure, and let me just put a simple case study before you. Uh, the target, the acquirer has identified a target company for acquisition, right? And the target company is acquirer is interested in various intangibles, trademarks, distribution network owned by the target. Based on the negotiation with the sellers, it is going to be a share deal, so that is very clear. Okay. Now, the acquisition company wishes to use debt for acquiring the shares in the target company. So what it sets up an SPV to acquire the shares, which then borrows from lenders against the corporate guarantee given by the acquirer, right? And based on that corporate guarantee of the acquirer, the SPV takes a debt financing and the shares of the target company acquired by the SPV. Now, how do you structure this deal? See, the interesting point here is that the debt is taken at the SPV level, whereas the business is the target co level. If SPV takes a debt to acquire the target co, how is the SPV ever going to service the debt, right? Because the SPV does not have funds, correct? Uh, if the acquirer was to take debt at its acquirer level, right, then again it would be saddled with a debt which is ultimately going to acquire the target co. So the acquirer's own cash flows might go away in repaying the debt, right? While it may not be able to use the cash flows of the target co. If the target co declares dividend and gives it to the SPV or the acquirer, in either situation there's a tax leakage because dividend is going to be taxable to repay the debt. So the question is that what's the most optimum structure to acquire the target co, right? Now, this is what we call as the leverage acquisition structure, where the SPV is going to take debt, acquire the target co, and extremely in a simultaneous manner, the SPV is going to be merged with the target co. So once the SPV is merged with the target co, what essentially happens is the debt taken by the SPV is residing in the target co. And on residing with the target co, the cash flows of the target co are used to repay the loan taken to acquire the target co itself. So ultimately, you use the loan in the target co to acquire the target co, right? So that's why it's called leverage acquisition structure. That you take a loan and then you push down the debt in the target co itself. Again, this is a very common structure which we see to sort of acquire targets when the intention is to acquire targets through debt financing. Again, like I said, any scheme of arrange or any corporate restructuring is a maze of regulations. And when the listed companies and you're doing a scheme of arrangement, then you need to follow certain SEBI regulations which are there. I have just noted some of the very key important points which are there in the SEBI master circular, but of course there are quite a few other areas also. So any scheme of arrangement in a listed company will require a prior stock exchange approval and then SEBI approval, right? Unless of course it's a transaction between a boss and a parent. Then if there are related party transactions or if in certain circumstances which are provided, it could be that the scheme of arrangement has to be approved by the majority of the minority. In the other words, the promoters or the interested related parties cannot vote for the scheme of arrangement. Then there are minimum public and institutional shareholders norms, the lock-in norms, there are onerous independent directors and audit committee report requirements, valuation reports, audit certificates. Again, these are a lot of procedural aspect, but each extremely critical when we are looking at any scheme of arrangement involving a listed company. Now, I think, friends, this was a bit of an overview of some of the recent structures and recent developments. And I think, like I said, it's a very short time. So what we'll do is in whatever time available, we will try and look at to the maximum extent possible. We'll look at some key developments, and we'll also look at some basic concepts. Uh, So first, I think before we go into the some detailing about amalgamation, it's a very simple diagram here. ABC Limited merging into XYZ Limited and XYZ Limited issuing shares to the shareholders of ABC Limited. So ultimately XYZ Limited, ABC Limited is eliminated and XYZ Limited has two shareholders post amalgamation, ABC and XYZ. Again, I'm not getting into definitions and all, but definitely, the requirement for a tax neutral demerger is that all properties and liabilities have to be transferred, and shareholders holding not less than 75% value of the amalgamating company can become shareholders of the amalgamated company. Shares, of course, can be equity or preference both. Now, I think there's an interesting recent development which has happened in the context of fast track mergers. So, what is essentially a fast track merger? See, there are two routes which are there, special routes which are there under the Companies Act for mergers. While the normal section 230 to 232 of the Companies Act is a regular chapter, a regular provision for merger amongst companies, there is a section 233 which we popularly call as a fast track merger. Essentially, under the fast track merger route, the powers for approval of the scheme of arrangement are given to the regional director, and therefore you are able to avoid the cumbersome NCLT route. Uh, this, of course, not all schemes are permissible under the fast track route, but essentially it covers uh, parent and a WAS scenarios. So when there's a parent and a wholly owned subsidiary company, that scenario is covered under Section 233 of the Companies Act. Also, the small companies are also covered. So when there are very small companies with certain limits lower than the limit specified, even those are covered under the fast track merger. And in this circumstances, you are able to avoid the NCLT process. Then there is another route which is called a cross border, which is Section 234, essentially read with Rule 25A. This was introduced in 2017, and this permits a merger of a foreign company and an Indian company, right? So again, the cross border mergers are covered under Section 234 of the Companies Act, both inbound and outbound. So both scenarios are covered here. Under the Section 234 of the Companies Act, there's requirement to get an RBI approval. Now, RBI is simultaneously with these, when the Companies Act was notified and Section 234 was introduced, RBI came up with its own set of regulations on cross-border merger and merger inbound and outbound. So based on this particular set of regulations, what happens is that the as long as you're fulfilling the conditions specified in the RBI notification, it is a deemed approval for the purpose of Section 234. Okay, so therefore, no specific approval or RBI required when you're merging or doing a cross-border merger between a foreign company and an Indian company. So this is essentially two rules, right? The fast-track merger rule and the cross-border merger route. Now, what has happened is that very recently, in a couple of months back, the government has now notified a, a particular rule in the cross-border merger rules, which is the Rule 25A, where it has said that now if a foreign holding company is merging into a Indian wholly owned subsidiary, reverse merger, then that can be done on the fast track route. So essentially what they are saying is that the fast track merger route can be used even for cross-border mergers in certain special circumstances, which is a merger of a Indian parent into its wholly owned Indian subsidiary. Sorry, a foreign parent into its Indian wholly owned subsidiary company. Now, the rationale is, of course, that most of you have heard of the reverse flipping. I remember a few years down the, few years back, many startups and large corporates used to come to us that what's the best way to flip the structure. And when we call flip the structure, it means that you sort of take the ownership of the company outside India, right? It could be Singapore, it could be US. So you are essentially, you flip the structure and you flip the ownership outside India. Now the times have changed. You would have heard of phone pay and razor pay, right? So a lot of the tech companies are doing reverse flipping. They believe that India is now able to appreciate and understand the valuations and these business models. So these unique business models, the earlier thought process was that India will not be able to appreciate the valuations, and therefore we will not be able to get the right valuation. And therefore the only way to sort of get investors is to take the ownership outside India. But recent times, we have 4 to 5 examples where we are seeing a reverse flip, where the foreign companies are now coming back to India. This particular structure will definitely help the reverse flip structure, and therefore the foreign companies can now, if they're looking to shift their base back to India, then they can definitely look to use the fast track route. There is a bit of an anomaly again that the fast track route refers to NCLT scheme under the RBI guidelines. So the RBI guidelines for cross-border merger, it refers to NCLT. It doesn't refer to the fast track merger scheme. So whether because the RBI is not aligned with the recent development, does it mean that if you are going to a fast track route for the cross-border merger, then in that case you need to still take RBI approval? I think that's going to be a gray area and something which has to be tested. Uh, Otherwise, I think the fast track merger route is definitely extremely welcome, because the way the NCLT processes the delays we have seen in recent times across states and across high court tribunals in various, definitely this will be useful for us to get that fast track. Now, the other point is that the nitty-gritties of merger fast track, I think in the interest of time, I will probably not be able to get into right now. Again, yeah. So I think with the carry forward losses, I think the merger has another advantages. Let's quickly move to the demerger. I think we're running short of time. Again, demerger is something where a company has two undertakings, and you sort of hive off or carve out the undertaking from one entity to another entity. So that's called the demerger route. Uh, the basic conditions for demerger is that you transfer all the properties and liabilities at book value, except where required for Ind AS compliance, and you discharge of shares on a proportionate basis, and allotment of shares for shareholding not less than three-fourths in value. Transfer should be on a going concern basis. Right? Uh, I think if I understand right, I may just have 5 more minutes left. So let me quickly take one very critical new development which has happened, which is the context of buyback. And this particular route, I believe, has now been effectively closed, because I feel that very few companies will very seriously look at this avenue going forward as a method of tax repatriation, right? The reason I say this is because from October 1, 2024, the current budget has said that the buyback proceeds are going to be taxable as dividend, right? And not only that, the sale consideration, the deduction of the expenses and the cost will also be not available to the recipient for the investors, and whatever cost they have, that will be allowed as a capital loss separately for future capital gains. So let's take a very simple example, and let's see the illustration on the right hand side. Number of shares acquired 100, cost of acquisition is 40 per share. Let's say the number of shares bought back is 20. Okay. So the buyback proceeds 60 per share is 1200. Now, what is going to happen is that the entire 1200 which an investor receives is going to be taxable as uh, deemed dividend. Okay. So now he has a cost of 40 into 2800. That 800 cannot be set off against the 1200 rupees of buyback proceeds. But he ends up paying a dividend tax in his hands on the entire 1200. And what happens to his cost? That is a capital loss to be carried forward and set off against future capital gains. Absolutely draconian, and not sure that after this particular amendment, how many companies will really seriously go for this buyback route. Again, this particular route has uh, you know increased the taxes for buyback tax from 23% to 36%, right? What happens when the shares are held by the investor as a capital, not as a capital asset, but as a stock in trade? What happens to the treaty treatment? Whether treaty will consider this as buyback of shares or capital gains? Will it treat it as a dividend? Whether the interpretation of the domestic law will prevail? uh, Redemption of preference shares are also now taxable as capital gains. Okay, this is again not linked to its dividend. It's taxable as dividend in the hands of the investor, but is not linked to accumulated profits. So even in a loss-making company which does buyback of shares, right, the investor ends up being taxed at as a dividend. Though the company whose shares are being bought back does not have accumulated profits, right? Of course, still certain nuances of structuring like Section ATM, which is essentially a rollover of dividend credit, the transfer pricing implications, etc., because it becomes a taxable in the foreign company. So those things still need to be evaluated. But by and large, I think that we can essentially say very safely that this provision means that there's going to be death knell for this entire buyback route going forward. Uh, I believe I would have exhausted my time by now, and of course, would have loved to cover the amalgamation, demerger, slump sales, all in much more detail. but probably some other time. So thank you all, and over to the moderator for taking it forward.
Yeah. Okay. So thank you very much, Nihalji sir, for your excellent deliberation, and I hope many of our member would have gained knowledge from your session. So now will be going towards the question and answer session. Some question has arrived from our participant. Shall I read it out, Nihal sir?
Yeah, sure, please, sir.
Yeah. Okay. The first question is that what additional technical qualifications could be useful for a CA in this arena?
Uh, Additional technical qualifications. So I'll tell you. The best way is, of course, that there could be certain courses, right, which govern the M&As, right, and those courses will probably give a bird eye view of various aspects of M&As and the corporate restructurings. So I believe that there are certain courses, and I think every individual should look out for those to gain in-depth knowledge. And but of course, like any other work, it is all about practical experience at the end of the day. And the more you work on deals and the more you get to experience hands-on experience, that is what is going to really matter.
Okay. Okay. Thank you. And the next question is that what would be the possible way out if any say seller company is 20 years old? If any seller company is 20 years old and its shareholder are not traceable, then how can the sale of company be done?
Uh, So again, I think we'll probably need some more facts that how many shares are not traceable and listed, unlisted. Because when you say not traceable, I'm assuming it is probably listed. Okay, but I think very very interesting question. I think the only way is probably to do some kind of a compulsory capital reduction is one option which can be looked at. And but the courts have, of course, taking a positive and negative view on this. But that could be one area which can be thought, especially if it is closely listed, close or as a listed company, then that makes much more easier. But otherwise, if the percentage of non-traceable shareholders is very small, maybe 2, 3, 4%, then effectively you can always buy out the balance shares and control the company. That's what we have generally seen in most cases. All listed companies, there'll be some amount of shareholder who is not traceable once the delisting is done of the listed company.
Okay, thank you. And the last question is that what will be the tax impact when a private limited company is converted into LLP when conditions specified in section 47 clause 13B are not fulfilled as per Income Tax Act?
So again, there are two views here, and one is that when you don't specifically comply with the conditions, it could become a taxable transfer, and there is also a negative ruling in this context. However, there have been certain positive rulings which says that a conversion of private limited into LLP is nothing but under a due statutory process of law, and therefore there's a vesting of the assets and liabilities, and therefore irrespective of whether you fulfill the conditions or not, the conversion is not taxable. Having said that, there is a difference between conversion of a private limited company or a partnership firm into company and the language there, and the company to LLP. The partnership firm into company, where most of the favorable rulings are there, use the word vesting. Whereas in the context of conversion of a company to LLP, the words user in the law are vesting and transfer. And therefore, we have seen that lawyers are much divided, that because of the words vesting and transfer, there is possibly a transfer. And if there's a transfer, there is a exposure in the hands of the shareholders of the company, because their shares in the company get extinguished and they get new shares and they get a share in the LLP. So that risk is very high in the case of a conversion of a company into LLP, while there are favorable legal opinions and precedents, but it's a matter of gray area.
Okay, excellent, sir. Thank you. So I hope all the queries of our participant have been resolved. which were asked from their end. So thank you very much, sir, for giving your precious time and valuable time with us and sharing the insight on this topic. So in the last part of this first webinar, now I would like to proceed for the vote of thanks. So on behalf of CP Committee of ICI extend my heartfelt gratitude to our distinguished speaker, C. Nihal Seth sir from Ahmedabad for delivering an insightful session on the corporate restructuring, the changing dynamics. Your clear and practical insights on these evolving topics have provided immense value to all of us. So thank you very much, sir, for your expertise and engaging us with your thought-provoking ideas. So thank you very much, sir, and have a great day. Thank you.
Thank you, thank you, thanks everyone. Thanks, Saketji. Pleasure is definitely
Thank you.
mine, and
Yeah,
look
thank you.
forward. Yeah, see you. Bye.
So now, dear participant, we are now moving towards our second webinar on our today's topic, which is of future of auditing, digital audits, and AI-driven assurance, which will be taken by our today's eminent speaker, C. Archana Dudecha Madam from Faridabad. So before proceeding, I would like to again inform you all that there will be no webinar on 25th of December 2024 on the occasion of Christmas and it being a public holiday. So now moving ahead, before giving the charge to our second session speaker, I would like to give the brief introduction about C. Archana Madam. C. Archana Madam, by profession and by singer, she believes in balancing work and passion and has more than 6 years of experience specializing in statutory audit. And she has also served as an anchor at CA Student Conference and other felicitation events contributing to our professional community. She has worked with PwC extensively with clients in the US territory, focusing on banking and capital market. She has expertise in auditing and financial reporting and brings a comprehensive understanding of both dynamic and global financial landscapes. So, with this brief introduction, now I would request our second session speaker, CA Archana Dudecha Madam, to please take the charge over this session and guide us participant. Now over to Archana Madam.
Yeah, thank you, Saket, for my introduction.
My pleasure, madam. Yes.
Yeah, so I hope you all are doing well and are excited to dive into an incredibly timely and crucial topic for the future of the auditing profession. Today, we will be exploring one of the most transformative trends in auditing, the role of audit and AI driven assurance. But before we jump into it, I want to hear from you and would like to get a quick sense of how familiar everyone is with digital audits and AI. Don't worry, it's not a test. Please take a moment to answer this poll. How confident are you in implementing AI or digital tools in your practice? The options are very confident, somewhat confident, and not confident at all. You can use your chat boxes and give your responses so that we can have those responses and proceed with the session. CS Saket sir, can you please check the responses and just let me know the responses of our beautiful audience?
Yeah, okay, definitely. 1 minute, madam. I am
Sure.
taking. Now, until yet, madam, the questions have not arrived. When the question arrive, I will definitely inform you.
Okay. So,
Yeah.
so we can go ahead with the session.
Yeah, you may, yes, please proceed.
Yeah.
Yes, in the last, we will take the question and answer session also.
Sure.
Yeah.
So during today's session, we will be breaking down our session into basics, some real life examples, which will be highlighting how tools can significantly enhance our audits. So we will be basically covering evolution of the auditing, and we will understand the digital audits and its tools like data analytics tools, cloud computing audit tools. We will also be covering AI driven assurance in auditing, its benefits and challenges in adopting those digital audits. There are few case studies of Big Fours, which will be also explained. Future of auditing and its trends and predictions will also be covered. Ethical and regulatory considerations in AI-driven accounting. What are the strategies that should be adopted by the chartered accountants to be ahead in this digital audit era? We need to upskill ourselves as well as a chartered accountant as per the near need in the future. There will be a funny fact at the end as well, so stay tuned for that. So, evolution of auditing. The auditing has been evolved so much since 1900 to 2024. In 1900, the audit was done physically, manually, paper-based documentation was done to verify the financial records. After that, the digital revolution came in 1990, where digital tools like data analysis were adopted to enhance the accuracy and reducing the manual errors. In 2010, cloud integration was done, which was a shift accessing the real-time data and collaborating more efficiently with the client, reshaping the entire auditing landscape. Now, in 2023 to 2024, the AI and the automation has evolved. In this, the analytics are revolutionizing the auditing. Various automation tools are streamlining the processes, enabling auditors to focus on higher level analysis and strategic decision making. This evolution of auditing has changed the auditing from traditional, which was manual, to automation, which is using AI. The need for digital audits arose due to the following reasons. Because in the traditional auditing, there was increasing volume of complex data that needs to be handled. Then there is a rising demand for real-time audits. There is enhanced regulatory requirements, and the clients expect greater transparency and efficiency. Understanding this evolution is crucial for grasping the current audit landscapes. So in the traditional auditing, it was manual. Like there were manual processes, reliance was on paper documentation, there was a significant human judgment involved. And also, it laid the foundation for financial accountability and transparency in the organizations. Then comes the digital transformation. In this, the technology revolutionized the auditing landscape by incorporating various softwares and automation tools that has enhanced the efficiency, accuracy, and ability to manage the volumes of data, which we called as modern auditing. In this, the auditing integrates advanced technologies such as artificial intelligence and big data analytics, enabling continuous auditing practices that provide real-time insights and foster proactive decision-making for the auditors. Now, we will be covering the digital audits. Like what is the digital audit? It refers to the application of digital tools and technologies to conduct audits. It enhances both the processes as well as outcomes. As we all know that the environment is rapidly evolving, so digital audits are becoming essential. They leverage the technology and data analytics to enhance the auditing process, ensuring more accurate and efficient outcomes. So there are core technologies which are driving these digital auditing, which includes data analytics for insightful analysis. There is an automation that streamlines the processes. There is cloud computing for accessibility and blockchain for secure transactions. In this presentation, we will be exploring how these innovations are transforming the future of auditing. The role of data analytics tools in auditing. Data analytics revolutionizes audit by providing deeper insights and patterns, enabling auditors to make informed decisions and improve audit quality. With advanced data analysis tools, auditors can examine vast data sets efficiently and identify anomalies and risks that traditional methods might miss. There are data visualization techniques as well, which allows the auditors to present the findings clearly and making complex data easier to understand for the stakeholders and enhancing the communication. Integrating data analytics fosters the proactive approach, which will allow the auditors to anticipate issues in advance, and they can adopt the strategies accordingly. By leveraging the predictive analysis, auditors can forecast trends and potential risks, and which will lead to more strategic decision making throughout the audit process. There are specific audit use cases for data analytics tools, which are Tableau, Alteryx, and Power BI. We will be discussing all these three and how they will be helpful in the auditing. Tableau. It will be helpful in fraud detection. How? It will be used to create the visualizations that highlight patterns in transaction data, which may be indicative of fraud, thereby helping in fraud detection. The another useful thing about Tableau in auditing is it helps to monitor compliance by visualizing adherence to regulatory requirements and internal policies such as timeliness of tax filings or compliance with the contract terms. It is also helpful in internal controls testing. Tableau can be used to visualize testing of internal controls, showing the effectiveness of controls in place and identifying area of weakness. Next comes the Power BI, and it is very helpful in the auditing. It helps the auditor in tracking the progress of the audits. Like it shows which areas have been completed and which are pending, ensuring that audit teams meet deadlines. It is similar to MIS, and it also helps in internal and external financial reporting. It consolidates both the reports into dynamic dashboards, which can be shared with the management or external shareholders, and which will help in informed decision making. It is also helpful in data reconciliation. It can be used for reconciling the accounts by comparing transaction data from multiple sources, ensuring all financial records match. Next comes the Alteryx. How it is helpful in auditing? It is used majorly for sampling purpose. As we all know that there is a huge data nowadays in the organizations and we cannot test all the population. So Alteryx helps us in sampling those huge data and perform our auditing. There are other benefits of Alteryx as well. One of them is data reconciliation. Alteryx can automate the comparison of different data sets such as bank statements and accounting records in order to identify the discrepancies or errors. The other important role of Alteryx in auditing is it helps auditors prepare and automate the generation of regulatory reports by transforming raw data into standardized formats for compliance reporting. The other helpful feature of Alteryx is predictive risk analysis. Alteryx predictive analysis capabilities can be used to forecast the risk, such as potential financial misstatements based on historical data trends, and help the auditors to take actions in advance and mitigate those risks. So these are the specific audit use cases for the data analytics tools. And data analytics is one of the tools of digital audit. Next comes this cloud computing audit tools, which is like we have already discussed, cloud computing is a part of digital audit. And what are the tools that will be used in the digital auditing? Cloud computing. So those are Audit Board and Caseware. We will be discussing those in our coming slides. So Audit Board, how it is helpful in the auditing? So it helps in centralized audit management. Audit Board provides centralized platform where auditors can manage all aspects of audit process. Auditors can track audit tasks, deadlines, and milestones in one place, ensuring nothing is overlooked and audit stays on schedule. Next, it will help us in automating the workflow and task management. So Audit Board allows automation of workflows from planning through execution, and it automatically assigns tasks to team members, set deadlines, and send reminders, improving the efficiency and reducing manual errors. Other helpful feature of Audit Board tool is risk management. The platform allows auditors to perform risk assessment, enabling them to focus on areas that present the highest risk. It is also helpful for internal controls and compliance. Audit Board simplifies the management of internal controls and compliance testing. It also helps automate the creation of testing documentation and reducing the administrative workload. So we can take up this Audit Board tool. We can also implement this in our auditing, in our practice, so that we can also get all the benefits that this tool is offering to us. The other tool in cloud computing is this Caseware. It helps in real-time collaboration by enabling multiple users to work on the same document or dataset, hence reducing the need for file sharing and version control issues. Using Caseware, team members can also comment or tag others directly within the tool to discuss specific audit findings. Hence, real-time collaboration can be done. The other is advanced analytics and data insights. Caseware offers powerful data analytics and visualization tools, helping the auditors analyze the large volumes of financial data more efficiently. By applying the analytics to financial data, auditors can quickly identify the outliers, patterns, or inconsistencies that could signal errors, frauds, or other financial risks. It also helps improve efficiency as well as accuracy. It automates the tasks such as data entry, calculations, reconciliations, and report generation. This significantly improves the speed and accuracy of the audit process, reducing the likelihood of errors due to manual input. Now, how AI-driven assurance is helpful in the auditing. As we all know that artificial intelligence has come up in 2023, and it plays a pivotal role in modern accounting. How? By routine task automation and providing the deep insights so that the auditors can focus on the complex issues and improving the audit quality and efficiency. What is the AI role in assurance? It utilizes the advanced algorithms and machine learning techniques to significantly enhance the quality of audits. ensuring thorough analysis and reliable results. There are various technologies used in AI. Some of them are explained below, and some of them are covered in the other slides. Several transformative technologies underlying the AI capabilities in audit includes machine learning, which is used for data patterns, NLP, that is natural language processing, for analyzing the text and reports, next term, the RPA, that is robotic process automation, for streamlining the repetitive task. By using these technologies in AI, we can enhance our audit and we can also create the audit more effective and qualitative. Benefits of implementing AI in audit. AI provides numerous advantages. Predictive analytics in AI helps foresee potential issues in advance and take informed decisions. It also provides real-time insights for immediate adjustments. So what does this machine learning tool does? It is the algorithms. It identifies patterns in large data sets and improve the risk management and fraud detection processes. The other one is natural language processing. Using this natural language processing, we can automate the review of contracts and documents. Because if we would be having contracts and documents, a large number of contracts and documents, and if we go and do manual checks, it will take our time, and there's a possibility that we might miss few things. So this natural language processing AI tool can automate the review of contracts and documents, thereby reducing the time spent on manual checks. It also enhances the collaboration among teams by streamlining the communication and ensuring the transparency in the assurance process. Now, we will be covering the benefits of digital audits. Digital audits offer numerous benefits, including enhanced efficiency, improved accuracy, and ability to conduct continuous monitoring. These advantages lead to more reliable financial reporting and greater stakeholder confidence. So these are 4 benefits that are majorly covered in this slide, which is efficiency and speed. Next is accuracy, cost effectiveness, and real-time insights. Automation significantly reduces the time spent on repetitive tasks, allowing the auditors to focus on more strategic activities that add value to the audit, thereby increasing the efficiency. Next, as there are advanced algorithms like machine learning, NLP are used, which will minimize the human errors, ensuring the audit results are reliable and precise. As we all know, that there is no necessity for physical presence and manual checks in digital auditing. So it will lead to lower operational costs and increased profitability. With the continuous auditing and monitoring capabilities, organizations can receive instant feedback and insights, enabling the timely decision making. If there are benefits, there are challenges as well in adopting those digital audits. So we will be covering challenges in this slide, which is data privacy concerns, the need for skilled personnel, potential technological failures, resistance to change, complexity of implementation, and regulatory issues. Data privacy and security. As all the data are secured in systems and we are doing the digital audits using various digital audit tools, so data security concerns are significant with auditors. So auditors need robust measures to protect sensitive financial information during digital processes. There will be resistance to change because the staff is accustomed to traditional methods of auditing. So transitioning to digital auditing from the traditional auditing challenges the staff and they resist to this change. Integration issues may arise. Why? Because the existing systems often require substantial adjustment to function effectively with the new digital auditing tools. So, implementation of these digital auditing tools is a complex issue. And it is a challenge for any organization to implement these new digital auditing tools that we have discussed earlier. There are regulatory issues as well. Compliance with regulations remains a hurdle, as digital auditing must meet stringent legal standards that differ between jurisdiction and industries. Now, we have few case studies where AI is used in auditing and a major benefit has been received by the organization for using AI and digital tools. Examining these successful case studies can provide insights into best practices and effective strategies for implementing digital audits. These examples demonstrate the tangible benefits that organizations have realized through digital transformation. Our case study one is digital audit success. This is an example from a global firm, a Big Four audit company, where the challenge was traditional audit inefficiencies. Like we all know, in traditional auditing, everything was manual. The data was very large. There was complexity. So, what this firm has done with the implementation of AI-driven tools using the Clear, and what the result was, their audit time was reduced by 30% and the accuracy has also improved. We have our case study 2, where AI-driven fraud detection success in identifying financial irregularities. This is an example from a regional audit firm where the problem was unidentified financial discrepancies. How this problem was resolved using the AI-powered fraud detection systems, and the outcome was it detected fraud 70% faster and with 90% accuracy. We have our case study 3, which relates to AI-driven transparency success. This is also an example from a Big Four audit firm where the problem was undetectable financial records. What solution was provided using the AI-driven technology? They have enhanced the real-time auditing by using the blockchain technology. The outcome was it ensured financial records, which was earlier undetectable, are now become transparent and traceable, and it has also enhanced trust among shareholders. Now, we have covered various tools. We have covered how the auditing has been evolved from traditional to digital. So, What will be the future of auditing? What will be the trends and predictions? The future of auditing will be marked by greater automation. As we've seen that there are various automation tools and we are moving forward with these automation tools. There will be real-time analytics using those data analytics tools that we have discussed earlier. One of them was Power BI. This Power BI helps in real-time analytics as it creates dashboards and we can share that with the management on a real-time basis and the changes can be made in them on a real-time basis. There will be an increased focus on cybersecurity, ESG, and forensic auditing. With the integration of AI, blockchain, cloud solutions, and advanced data analytics, auditors will not only perform more efficient and accurate audits, but they can also provide valuable insights to help the organization navigate a complex, data-driven world. Auditors will need to adapt their skills. They need to upskill themselves and methodologies to keep pace with technological innovations and changing regulatory environments, thereby ensuring the role remains critical in safeguarding transparency and accountability in financial reporting. We will be covering ethical and regulatory considerations in AI-driven accounting. As we are working online, as we are working digitally, so we need to take care of these ethical considerations and the regulatory considerations because we have data of our clients and we need to protect them as well. So using these regulatory considerations and ethical considerations, we can keep these things in mind while auditing. As we all know that digital audits have become more prevalent than before, so understanding these considerations has become very, very crucial. Regular audits of AI models are necessary because we are using AI for our audits. So audit of those AI models has become very necessary to ensure the fairness and mitigate the bias in financial decision making. Accountants must ensure AI decisions are explainable, allowing auditors and stakeholders to understand and trust AI-driven insights. Compliance with data protection regulations like GDPR. What is this GDPR? It is Journal Data Protection Regulations, which will be essential to safeguard the client data. So auditor needs to check those compliances related to these data protection regulations. AI in accounting must comply with the local and international accounting standards as well as regulatory frameworks such as IFRS or Sarbanes-Oxley Act. There should be continuous monitoring in order to ensure AI applications stay aligned with evolving legal and regulatory requirements. Ethical use of AI demands that accountants exercise professional skepticism and oversight, particularly in high-stake decisions. There are various strategies that needs to be adopted by the chartered accountants. As the evolving landscape demand that auditors acquire new skills in technology, data analysis, and critical thinking, continuous professional development has become essential to adapt to the changing requirement of the auditing profession. Chartered accountants must embrace the technology and automation to enhance the efficiency and reduce the manual tasks, ensuring they remain relevant and valuable. Continuous professional development is essential. Accountants should pursue further certifications and training to adapt to the changing regulation and standards. We can search on various platforms and we can upskill ourselves by doing various certifications relating to these digital audit tools as well as AI driven tools. As earlier discussed, these are the future of auditing. So we will need to adapt to these changing tools. We need to build the strong client relationships through personalized services, thereby helping the chartered accountants maintaining their loyalty and trust amidst this competition. We should be leveraging data analytics, which can provide accountants with insights that drive better decision making and strategic planning for their clients. Networking and collaboration with other professionals can create opportunities, sharing the knowledge and fostering the innovation in the accounting field. So there are various skills that is needed for the chartered accountants in the near future. As the auditing increasingly becomes digitalized, CAs will need a solid understanding of various digital tools and platforms that enhance the auditing process. We will be covering those skills that can be developed by a chartered accountant so that they can stay ahead in the future. One of them is data analytics. We have covered Tableau, Power BI, and Auditing. So familiarity with these tools is required for a chartered accountant in order to analyze the large data sets and to uncover the patterns, trends, and anomalies. They should also upgrade themselves with the blockchain knowledge. They should have basic understanding of the blockchain technology, which is emerging in the financial industry for secure and transparent transactions. Cloud computing, they should also become proficient in these cloud-based accounting and audit tools like Audit Board, Caseware. We have already discussed these audit tools earlier, which will streamline the workflows and increase our efficiency. There are various automation tools. We need to understand how we can implement and use those AI tools to automate the tasks like data extraction, risk assessment, and sampling. We can also use predictive analysis and we can upskill ourselves in this using the machine learning algorithms to predict the risk and detect the anomalies and identify potential areas of fraud or misstatement in financial statements. So, as already promised, like we will be sharing this funny fact at the end. So, what is this funny fact? We are saying that we will be doing the digital audits using these digital audit tools like data analytics, which covers Tableau, Alteryx, Power BI, and we have other tools like cloud computing, which covers Audit Board, Caseware. There are another tool which is blockchain technology. So we are saying that we can use these digital tools and AI in order to perform auditing in future. But what? If the future of auditing with these digital audits and AI-driven assurance is that one day AI may end up auditing itself. You can imagine a scenario where an AI system is used to audit another AI system's calculations, decisions, and data patterns. You could have a conversation where one AI is like, wait, I see a mistake in your algorithms. Let me correct you. It like the robots auditing the robots with no human insight, except maybe to enjoy the show. So in the future, auditors may find themselves just overseeing an endless loop of digital self-checks, where the biggest challenge is making sure the AI doesn't accidentally give itself a perfect score on every audit, and it's the kind of audit inception that the future could bring. We have come to the end of the session. There are various key takeaways. As we all know that digital audits and AI are revolutionizing the auditing practices. There are benefits like speed, accuracy, and real-time reporting. Our efficiency will be increased, our speed will be increased, there will be accuracy in our data. Okay, there will be real-time reporting. We can check up the workflows on a real-time basis. There will be efficiency, there will be quality in our audits. But there might be few challenges as well. First will be the cost of implementation, and the other is upskilling. We as a chartered accountants need to upskill ourselves in these data analytics tools because this is the future of auditing. If we do not upskill ourselves, we will be left far behind. So we need to upskill ourselves by doing further certifications in Tableau, Alteryx, and the other one was Power BI. We can also have understanding of audit board and the caseware, blockchain technology, which is widely used in order to have the real-time auditing and to ensure that there is a transparent financial records which are traceable, which will be helpful in gaining the trust of our shareholders. Next, we need to stay updated, thereby ensuring the professional growth and the relevance. So, I hope we will be embracing these changes in the near future. So, in conclusion, the integration of digital audits and AI is not just a trend, but a necessity for the future of auditing. Embracing these changes will lead to more effective and efficient audit processes, ultimately benefiting all the stakeholders. Now, I would like you all to encourage and to explore the tools that we have discussed in this session and stay updated on the AI advancements and incorporate these skills into the work. The future of auditing is really exciting. Digital tools like Tableau, Power BI, Alteryx, and AI tools such as machine learning, RPA, and NLP, natural language processing. These digital tools and AI are not replacing as an auditors, but they are empowering us to do more complex as we all know, as we have discussed, that the data set is too large in the organization. So it empowers us to do more complex, insightful, and timely work with quality. So thank you, audience, for your time in session. At the end of the session, I just would to like to again ask that same question, like how confident are you now to implement these AI and digital tools? It will be very appreciative if you could share your inputs. Now, I would like to hand over the session to our moderator, C. Sake.
Yes, thank you very much, ma'am, for your excellent presentation on this topic regarding this webinar. I am just searching for the answer of our participant regarding your question. Uh, Many of our member have written that somewhat confident, uh, some are slightly confident. That's all answer have arrived for your question. And
Wow,
yeah. And
great.
now I am moving towards now question and answer session. So shall I read the question which have arrived on my desk?
Yeah, sure.
Yes, ma'am. Now, first question from a member has arrived that what role do you foresee that blockchain will play in the future of audits?
Blockchain is a very important tool, and it also helps various, as I have already discussed, that it has helped one of the big four audit firm in detecting the traceable data. Like they were not able to identify various financial records, and using those blockchain technology, they were able to implement those financial records. They were able to trace those records and thereby enhancing the trust of the shareholders. So, yes, blockchain technology is the future of audit, and we need to upskill ourselves in this.
Okay. Yes. Second question that how does AI enhance the quality and efficiency of our audit?
Yeah. So, as we have already discussed, that how AI will enhance our audit, we can use various tools like machine learning, and we can use natural language processing. We can also use the robotic process automation. These are all AI driven assurance tools. So, using these, the organization can identify the patterns and the large data sets. And they can also automate the review of their documents and thereby reducing the time spent on the manual checks.
Okay. And the next question is that can you, ma'am, please suggest the tool for small scale audit firm regarding the solution which is incorporated that data analytics, work process, working paper management, which is either freely available or at economical price? Is there some apps, yeah, or tools that member can use?
Right now, I would not be able to answer this question related to the small firms. But yes, I would definitely reach out. You can reach out to me, the person who has asked this question, and I would be happy to answer your question.
Yeah, sure. I will suggest you. And then the last question is that how do you see digital audits transforming the traditional auditing landscape?
Yeah, it has changed a lot. Like in the traditional auditing, what we are doing, the paper documentation, we are doing manual processes. There was a significant human judgment involved. But in the digital auditing, it has changed a lot. Although human judgment needs to be involved in there, but paper documentation has totally been changed. using those automation tools, and the manual process has been changed to automation. And using those data analytics tools, we can automate our data and we can perform auditing in a much efficient way.
Okay. Thank you very much, ma'am, for giving the answer regarding the query which were asked in the chat box. So, and for your question that how much the members are confident, I would say the many of our members have written that they are now more confident with this presentation, with our presentation.
Wow, that
And yeah, and they are willing to do the audit in this AI digital manner also in the upcoming months.
yeah, great.
Yeah,
I think the future of auditing is this only, and we need to upskills as a chartered
definitely.
accountants. We cannot rely on those traditional auditing and those doing checks and checks.
Yeah,
We,
yeah, yes.
yeah, it is a time saving, and we can have other complex issues that can be resolved, and we can become efficient auditor as well. So I think I am very helpful, and I'm very like confident now that you are seeing this as your what can I say, like you have given this as a somewhat confident, some are very confident after this
Yeah, yeah.
presentation. So it's great to see that some of you are already embracing, and some of
De-
you will already embrace, and you will embrace this in the future as well.
Definitely, ma'am. I am sure that many of our members will definitely now do their audit with the help of AI tool only. In the
Yeah,
upcoming months or years, we can say that. That's
yeah,
the future of our auditing.
yeah. Power BI will be the future.
Yeah,
Power
Power
BI and
BI.
Auditing, like they are
Yeah, yeah,
great.
definitely, definitely. That Microsoft Pilot is also there, I think. In
Yeah,
that, they
yeah.
can also use that app also. Our institute also providing that app also,
Yes,
co-pilot
yes,
version.
yes.
Yeah, yeah. Thank you. So thank you very much, ma'am, for giving your valuable inputs and your precious time with us for this webinar. And I am feeling very much proud to inform you all that more than 925 participants have already joined this session and have gained the ample of knowledge from this AI webinar, which is organized by our CP committee of ICI. And I am sure that many a member would have gained the ample of knowledge with your webinar. So
Yeah,
thank you very much, ma'am. And
thank
now
you,
I
sir.
would like to again announce the information that there will be no webinar on 25th of December 2024 on the occasion of Christmas and it being a public holiday. So now I am inching towards the last part of our today's webinar, that is vote of thanks. So, I, CA Saket Mehta, on behalf of CP Committee of ICI, I extend my sincere gratitude to CA Archana Dudecha Madam for delivering an insightful session on future of auditing, digital audits and AI-driven assurance. I would say that your presentation has shed light on the transformative role of technology in auditing and provided us with a glimpse into the future of our profession. I would say that the practical insights and forward looking perspective shared today will surely help us adapt to the evolving landscape of digital audit and AI. So I would also thank all the participants for their enthusiastic involvement and the CP committee for organizing another impactful webinar for our members. So thank you one and all for your support. So thank you very much one and all. Have a nice day. Thank you.
Thank you.